Good afternoon and welcome to the third quarterly pricing webinar of the year, when I'll be looking at pricing movements in motor and home insurance for the second quarter of 2025, going back a bit further and thinking about what might be coming next. As always, if you are a regular, then please feel free to leave any questions in the chat, and hopefully I'll be able to answer some of those at the end of the presentation. Firstly, a little background on Pearson Ham. So we are a pricing consultancy. Pricing is what we do, and we support with pricing strategy, teams, governance and processes, systems, tools, analytics and data, and price optimization. In insurance, we also provide market pricing insight services, which is where the data that we will be looking at today comes from. A little bit on the process. So we have panels of consumers who we've recruited, and they've given us permission to use their details. And we use their real risk profile. So whatever that person would enter themselves into a comparison site is the information that we enter on their behalf. So it's all genuine people with real risk profiles, and it's useful to be able to track on a like-for-like basis. So these are the same people that will be running between different days and between different months. We're able to capture that like-for-like price movement. So it's not going to be impacted by changes in mix or anything else that might be influencing the prices that are coming back. So it's a like-for-like view on price movements. We have agreements in place with the big four PCWs, so we're able to run prices through those, and we do that every day. We have a panel rotation, so we try to replicate human behavior as much as possible, so we're not running everybody every day. So there's a rotation of people running when we would expect them to run in reality, so that we are mitigating the risk of any kind of seen before or other velocity rules that might impact on some of the prices that are coming back. Those can't be avoided 100%, so we have to do some data cleansing once the prices have been collected, and we do that. So we have to make sure that what we report are genuine price movements and not price movements that could be triggered by the process itself. So it's actual price changes that we capture, and we produce the key metrics and data reporting for our clients, and they are able to use that, and that informs their regular day-to-day pricing decision-making processes. Currently, we are active in car insurance, home insurance, van, pet, travel, and landlord insurance. So if you have any questions or are interested in finding out more about any of those, then please drop me a line after the presentation, and I will be happy to answer any questions that you have. Okay, so moving on to Q2, and we shall look at motor insurance first. So we'll cover motor, and then we'll look at home insurance, combined cover, and then contents only, and then I'll have a bit of a think about what might be coming next, what are the key drivers of price movements in these markets, and what can we expect for the rest of the year. So looking at motor insurance, first, what's happened in the past quarter? So we've seen prices drop by another 4% over the past 3 months. So this is the average of the top 5 quoted prices. So this is an indication of what competitive prices are doing. So at the end of last quarter, it looked as though the rate of price decrease was slowing down a bit. But over the past couple of months, we've seen a couple of sharp reductions coming in there. So actually things look as though they are continuing in the same vein as they have been over the past few months. So if we look at that, take that back to the beginning of the year. So far this year, the average of the top 5 prices has dropped by 7.5%. So we can see that there were large reductions in January, which seemed to kind of ease off a bit as we progressed throughout the next few months. But we've seen some big cuts coming back in over the past couple of months. So 7.5% so far this year. And as we go back for 12 months, so this time last year, prices are around 16.5% lower than they were 12 months ago. So we can see that at the end of 2024, there were some very hefty monthly price reductions coming in. So things have eased off a bit, certainly in February, March and April. We've seen May and June return to similar levels, but certainly we're not at the same rate of decline as we were at the end of 2024. If we go back slightly further, over a 24-month period, so prices are now around 7% lower than they were 2 years ago. So we can see kind of the tail end of the premium inflation at the middle of, towards the end of 2023, when prices started to fall and competition became much more intense. And that's been the case really since November 2023. This is a favorite of mine, so I like to go back a little bit further and look at pre-COVID. So going back to the beginning of 2020, and I think at that time, I was expecting that prices would start to rise. I think we had seen some drops throughout 2019, and I think it was getting to a position where it didn't look as though that was going to be sustainable for much longer. So I think as we started the year, we came into 2020 and prices did start to creep up. However, March, we got hit by COVID, that threw everything out of the window. And we then saw changes in customer behavior, obviously driven by lockdown. So people aren't on the roads. The kind of claims frequency has completely dropped off. So prices were reduced to reflect that. So all through 2020, 2021, we saw prices dropping. The GIP changes, the general insurance pricing practices changes, and the ban on dual pricing meant that new business and renewal prices had to be rebalanced, and that resulted in a quite a sharp increase in new business pricing. So we saw that coming in beginning of 2022. So January, a sudden increase in prices, a bit of a recalibration after that. And then we saw in 2022 and throughout 2023 massive inflation, so claims inflation, so the cost of claims, and driven by overall inflation, labor shortages, cost of parts and materials, availability of parts and material. So all of these things combined together and caused massive claims inflation and subsequent premium inflation to cover the cost of those claims. So obviously, insurers in a loss-making position need to be able to do something to try and make up for that. And we saw prices increase to a point where they were 46% higher than the beginning of 2020. So this is around November 2023 is when we then started to see increasing competition within the market. So the peak we're looking at there was the kind of the middle of 2023. That started to drop off again. I think insurers have got themselves into a more comfortable position in terms of being able to cover the cost of claims. So those increases started to tail off. But then, as I say, from November 2023, we saw much more intense competition within the market. And that's been the case really ever since. And prices have dropped every month, bar a couple at the beginning, but they've dropped quite significantly each month during that period. So that's where we are now. So prices have come down quite a lot. We're still 12.3% higher than they were at the beginning of 2020. I think at that time, I was expecting them to come up. To what level, I'm not quite sure, but as I say, we're still 12.3% high. We'll come back when we have the summary at the end. I'll come back and look at some of this as well. So we looked at the average of the top 5 movements. So the 4% drop in Q2, but that does mask kind of quite a lot of divergent pricing movements and activities by insurers when you look at an individual level. So this is not more or less the kind of the top 10 in terms of size providers in the market. So we can see that it's not consistent. So the 4% drop on average from competitive prices masks a range of increases and reductions. So we can see ranging from 7.4% or drop on average prices quoted from one provider to an increase of 4.7% during the quarter for another provider. So we are seeing different strategies playing out, and that's why you just need to be a little bit careful about looking at the market averages when trying to track what's going on. Thinking about, well, why do you need to know what's going on in the market and why do you want to track it? It's really to understand the impact that it's going to have on your performance. And that, again, would require a little bit more detail to understand what is it that's causing these movements, what competitors are moving in which direction, who are my core competitors, who's within my footprint, and what are the products that are changing. So there are new products coming in, there are old products moving out, product price movements are happening at different levels and different rates. So it's important to be able to understand that detail to get a really good view on what's going to impact your own trading performance. So this is looking at those providers trended over a 12-month period. So where we've seen prices dropping over the last quarter, the year-on-year changes are between kind of 11 and 20% down. So thinking about that, around 60% average drop. This is what's kind of driving a lot of that. So if these competitors are in your trading footprint, then it's going to be quite tough because of the kind of more competitive nature of those segments and that you may be targeting. And this is the next tranche of those providers. So where rates have increased or have remained fairly flat year on year in the quarter, year-on-year prices are still lower, but not to the same extent. So we're looking at somewhere between 3% and 13% down on last year, rather than the 10 to 20, 15 to 20% that we saw for the others, where the larger price reductions or price reductions have been deployed. So there are, as we can see, differences in approach and differences in strategy, and each insurer or broker will have their own appetites and growth strategies which will be driving some of this. There's also risk appetites for insurers and how much they're willing to take on in terms of new business at this stage. And that kind of is leading to some of the divergent movements that we are seeing now. So even if we're looking at a segmented level, so this is driver age. So it's a good example because we can see there's quite a narrow range here in terms of year-on-year price movements. So between 15 and 17% down year on year. So the younger drivers tend to have seen the biggest price drops, but there isn't that much in it. So there's only a couple of percent variance in the overall year-on-year price movements. If we're then looking at some of these providers, and bearing in mind these are some of the biggest providers, like top 10 largest in terms of PCW market share, then we can see that actually there is quite a difference. So in the quarter, we've seen prices drop fairly consistently by driver age. So the younger drivers have seen lower reductions than some of the older ones. The middle age is where they've seen the biggest reductions coming in. But quite a kind of a different view when you look at it next to this particular provider. Subscribers and to our data, so our clients are able to see who these providers are. So it's not just all it's anonymized for the purpose of this webinar, but if you were a client of ours, you'll be able to see who these particular competitors are and whether they are within your competitive footprint, and what should you do in response to some of the movements that we're seeing. So we can see here, so large increases are targeted at some of the older drivers, with reductions continuing for the youngest from this particular insurer. So I think if we're looking at this and you've only got access to the market averages, then you may be wondering why performance doesn't quite reflect the movements that you're seeing. And actually, there's a lot more going on underneath that you need to be aware of. This is another provider, so where prices have increased. So we can see that prices have increased overall over the past 3 months, but those increases have been larger for some of the older drivers, and the level of increase has been lower for younger drivers. So we can see there are targeted strategies going on, and both in terms of the magnitude of change and the direction of change. So it's really quite a complex and interesting market at the moment. This is showing that provider 10 kind of trended over the past 12 months in the same way as we looked at on the previous slides. So we can see that some of the recent changes are really kind of bringing things back into line with the overall market. So if we're looking at the average of competitive quoted prices, then certainly for age 41 to 50, the year-on-year changes are kind of pretty close. Under 26s, those year-on-year changes are pretty close. But some of those others have gone a bit beyond the market movement. So I think there may be opportunities created if you are a competitor of this particular insurer, where their prices have increased and they are now a bit out of line with the overall competitive marketplace. So as I say, it's a really interesting time. It's a complex and interesting market that we are looking at the moment. And I think it really is down to your own individual competitive set in terms of how your performance is going to be impacted by some of the changes that we're seeing within the market. So that's motor. Moving on to home insurance next. So this is combined buildings and contents cover first, and it's the same view. So this is the average of the top 5 prices quoted across the big 4 PCWs. So it's a view on how competitive prices have moved over that period. And we can see it's a similar picture to motor. So over the past couple of months, prices have dropped down by 3.8%, and the biggest reductions have been seen over the past couple of months. So again, it's taken home slightly longer to move into premium deflation. I think insurers are rightly cautious. There are unexpected weather events which are becoming more common. So it's prudent to factor that into your pricing calculations. But we have seen that there looks to be a trend towards prices moving down within the home market at the moment. So looking at the performance the year to date, so over the past 6 months, we've seen prices drop by around 7% in home insurance. So as I say, apart from April, the trend looks to be increasing. So each month we're seeing bigger price reductions. So certainly in May and June, we've seen larger price reductions than other months earlier in the year. And then looking back over the course of the past year, prices are now 8% lower. So 7% of that has come in the past 6 months. So we did take a bit longer, as I said, in terms of when premium deflation started within the home market. It did start a bit later than with motor. So we can see what's happening in the second half of last year, how that looks quite different to what's being experienced in the first half of this year. So again, it's going to be a tough trading environment for those of us who are active in the home insurance market. So looking back a little bit further, we can get quite a clear view. It's a kind of a tale of two halves here. It's a game of two halves where we can see from 2023 that kind of steep premium inflation and then kind of switching. So prices are still now 23.6% higher than they were 2 years ago. So this is due to the significant inflation that we saw in 2022, 2023 within the market. So it's going to take a bit to erode that. So I think that's why we're seeing the increased and more intense competition within the market. I think that a bit of a buffer was built over the past couple of years, which has enabled those insurers who feel brave enough to start to try and drive new business growth. Looking at this at an individual insurer level, so these are 10 of the large providers within home for combined cover. So we can see again, it's not consistent across individual providers. So if we're looking at that 3.8% average drop for competitive prices over the past 3 months, then actually that masks a lot of the underlying activity. So we can see here there's a range of price movements from 6.7% down to 3.2% up during that period. And looking at how those are trended over the past year. So this is where we've seen the biggest price reductions in the last quarter for those particular insurers. And the year-on-year movements, we can see here, they're ranging between 2% up year-on-year or 8% down year-on-year. So there are some differences in kind of year-on-year movements and not quite as large a gap as we might have seen on motor. And where we are seeing smaller reductions, again, we're seeing a year-on-year difference of between plus 4% or minus 6%. So those year-on-year changes are not quite as drastic as we're seeing on motor, which could mean that there's still some fuel left in the tank for home insurers to be able to continue to try and drive new business growth. So when we're looking at where the smaller reductions have happened in the past quarter, we do see some steeper price cuts earlier in the year. So that may mean that they don't need to go much further. They've got to a place where they're relatively happy, but obviously they're going to be impacted by their competitors' movements. So that's something which may impact and influence what they do next. Okay, so moving on to contents only. So again, it's a similar picture. We're seeing a drop of 5.2% in the quarter, with price reductions being observed every month. And again, similar to combined cover, the rate of increase, the rate of reduction has increased as we've moved through the year. So we're seeing larger monthly price reductions each month in the last quarter than we saw at the beginning of the year. And similar to combined cover over the past year, we're seeing 8.6% year-on-year average movement, so 8.6% down on the year, and most of that happening in the first half of this year. So similar picture to what we've observed previously and over the past couple of years. Again, it's the same thing. So premium inflation in 2022, 2023, enough of kind of increases in premium to be able to cover cost of claims, and then looking at a much more competitive market and prices dropping, and that dropping more significantly this year. Again, there's a bit of a range in terms of what we're seeing by individual provider, but not quite as stark as combined cover and motor insurance, where we're seeing some larger increases over the quarter. So mostly prices are coming down. Some are remaining relatively flat. So price where there are increases, they're less than 1%. But we're seeing the reductions range from 1 to 11%. So the average is kind of masking a bit of what we're seeing by individual providers. And for some of those providers, so thinking about number 9, where we've seen 0.7% increase, actually that's been driven by June. So we've seen some more volatile monthly price changes from some providers. So looking at that over a trended 12-month period, we're looking at somewhere between 1% and 20% down for those providers where we've seen the largest reductions in Q2, and where there were smaller reductions or slight increases, then we're seeing a range between plus 13% up year on year or 6% down. So there are some more kind of volatile providers out there with more erratic movements, but kind of the norm is on the kind of lower side of this chart, I think. Okay, so looking ahead to the rest of the year into Q3 and until the year end, what do we expect to see? So as always, it's quite a difficult market to predict what's going to happen. And as I say, there's a lot happening in the detail at the moment. So even if we're tracking the average of the top 5, I think it's a good indicator, and it gives a view as to how competitive prices are moving within the market. But the average of the top 5 does mask a lot of underlying divergent pricing activities. So I think there's certainly a benefit in tracking the top 5, and there's room for market price modeling using kind of the large PCW data sets that are out there, but we must be aware of the limitations of those. So competitors may not be moving at the same rate as the market, or even in the same direction in many cases. So if we're using this to be able to track and monitor and understand our own trading position, then it's really important to be able to do that at an individual provider level. Product strategies, so pricing and product strategies are combining. So we're seeing a lot of new products continuing to enter the market. So this wasn't just an immediate post-JIP thing. So we saw the economy tiers taking most of the top slots, and that now is the case on all of the PCWs, really, where the top 5 that we're tracking is essentially made up of the economy tiers that came onto the market post-JIP. But we are seeing a lot more product development. So whether it's online only or whether it's new branding seeing new products out there, and these could be linked to back book versus front book strategies. And again, that's going to impact your position if it's your competitors who are doing that. So this is the kind of the fish icon here is competitive positioning. So your competitive position and performance is likely to be driven by specific competitors. So it's those guys that you really need to know what they're doing, not just in terms of how they're moving their prices, what they're doing with their products and their propositions, and how might that be impacting on your not just competitive position, but your click-through and your conversion rates, which may not be moving in the same direction as your overall price competitiveness. And lastly here, the competitors will be dictated by footprint, product, and brand as well as price. So we do see big variances in quotability by providers. So some with kind of very broad, some with very narrow footprints. And if they're in the same footprint as you are in, then you need to be understanding what changes they're making. So where are things going to go from here? So insurer profitability really is going to inform how much more insurers can compete. So EY is predicting the COR is going to move from 100% this year to 107% next year. So that, again, that is going to cause some challenges. So we would expect prices to start to rise. You need to be checking your competitors' financial results to see where do they sit. So not all insurers are going to be reporting 107% COR. Some will still have room to move and be able to take advantage and drive some growth through new business. Motor started earlier, so I think there's probably some further reductions to come in motor, but there has to be a leveling out at some point. But I think there are still insurers who could continue to move over the next few months. So I would expect in Q3 prices to drop again. In home, they could probably go a bit further. It started later. So again, depending on how the climate and weather events that are kind of caused by climate change play out over the next few months, then if things remain fairly stable, then I think we would expect to see bigger drops in home as well. So I think that's brought us to the end. I've slightly run over, so I shall leave the Q&A. If you do have any questions, then please do feel free to contact me directly, and I'll be happy to answer any that you may have. And I shall look forward to the next webinar at the end of Q3. Have a good day, and I shall see you next time.